successful real estate investing hinges on identifying lucrative opportunities. Once a promising deal has been unearthed and the property thoroughly researched, investors often expedite the process by proceeding with a sale or exploring other options. Nonetheless, it is crucial to acknowledge that locating and analyzing real estate deals can be an arduous and time-intensive endeavor demanding considerable dedication and exertion. How to analyze real estate deals. After discovering a promising real estate opportunity, it is crucial to conduct a thorough analysis to ascertain its potential for generating consistent cash flow. By meticulously calculating key real estate metrics, investors can make informed decisions regarding the viability of the investment. The following steps outline the process to determine your readiness to invest. 1. Analyze the investment location. 2. Collect your data. 3. Calculate monthly cash flow. 4. Figure out annual ROI. 5. Compare with other rentals. Analyze the investment location. The importance of location cannot be overstated when it comes to rental properties. The impact of location extends to critical factors such as property price, rental rates, tenant demographics, property appreciation, and more. Consequently, the profitability of your property is ultimately influenced by its location. If you find yourself uncertain about what constitutes a favorable location, it is advisable to consider several key factors. For instance, examine the population growth, job opportunities, economic growth, and price-to-rent ratio in the area. Additionally, take into account factors such as safety and crime rates, school ratings, taxes, and local laws. Armed with this information, you can assess the rental potential of your chosen location. Collect your data. Engaging in real estate investing entails a continual examination of numbers and data associated with each property listed for sale. As an investor, you typically employ this information to assess the profitability of properties that capture your interest. However, if your calculations are inaccurate or crucial information is missing, you risk obtaining unreliable estimates of your projected returns. Therefore, it is imperative to gather all the essential data required for conducting a comprehensive rental property analysis. For instance, you will need to acquire pertinent information and figures about the following aspects: taxes, property listing price, insurance, interest rates, down payment, mortgage payment, utilities, HOA fees, vacancies, rental rate, repairs or renovations, maintenance. Acquiring all the necessary data for your rental investment analysis may require some thorough investigation, but the effort will be worthwhile when you obtain a more precise estimate of significant expenses. Calculate monthly cash flow. Once you have obtained the property location and expense data, you can delve deeper into evaluating the deal by calculating the monthly cash flow. A profitable rental property will yield positive cash flow, indicating that your income exceeds your expenses. However, it is crucial to accurately calculate both income and expenses to determine the property's profitability. To calculate the rental income, you simply need to subtract rental costs and expenses from the projected revenue. However, before proceeding, it is necessary to establish an income estimate. One effective method is to apply the 2% rule, which suggests that the property's rent should amount to 2% of the purchase price. This guideline ensures sufficient coverage of regular monthly expenses and generates a healthy cash flow. Figure out annual ROI. When analyzing real estate deals, a critical step is to calculate your annual rate of return. There are various methods to estimate your returns, such as utilizing the gross rent multiplier or the net operating income approach. The GRM assesses the relationship between the property's purchase price and the gross rent it generates annually. However, it disregards expenses in its calculation. Conversely, NOI determines the rental's profitability by accounting for the income left after deducting expenses. As you can imagine, gathering all the necessary figures and performing calculations for rental investments can be time-consuming and demanding. Fortunately, there are numerous tools available to aid in analyzing real estate deals and managing properties once you have identified a promising opportunity. Compare with other rentals. Lastly, a crucial step in analyzing real estate deals involves conducting a comparative analysis of your property with similar ones. This comparison aids in determining whether the property is priced at fair market value. Performing a comparative market analysis entails evaluating the property about recently sold properties within the same location. For the most accurate comparison, it is essential to consider factors such as age, square footage, condition, location, and more, ensuring the properties share similarities. Real estate investors can obtain real estate comps by seeking assistance from real estate agents, utilizing online tools, or engaging property management companies. Thank you for watching. We hope this video has provided you with valuable insights into the world of real estate investing. If you're interested in delving deeper into the basics of real estate investing, we invite you to click on the video displayed on your screen. This video covers essential concepts and strategies for beginners in real estate investing. Start your journey toward financial growth and success in the real estate market today. Happy investing!